Hello everyone, this is going to be the start of a series where we explain the cost of capital in finance. Now the cost of capital is a hotly debated area in finance, and in this video series that we're going to introduce you to, we're going to try and explain through what the cost of capital itself as a concept is, and then we're going to try and teach you the basic ways of calculating it. So although this concept can be very complex to understand, one should always think of it as the opportunity cost of their money. So for an investor, this is their required return. If their investment exceeds this required return, then the logical investor should invest in this project. Alright, a good way to conceptualize the cost of capital is to think of yourself as getting a job somewhere. Now when you're getting a job somewhere, you're trying to think about how much an hour of your time is worth. So you think about how much you want to get paid for an hour of your time. The cost of capital is very similar. Instead, you're thinking about how much the time value of your money is worth.
As Jonathan has just said, with the comparison between the required rate of return as well as an investment, if there's going to be higher risk involved, you're going to want to be paid a higher premium for that increased risk. So for example, gold has historically been seen as a very safe asset where your money will hold its purchasing power over time. However, if we look in the past 10 years, we see that gold has had a very small return. And once we account for inflation and historically low interest rates, this has actually been a negative return. If we look at the wider stock market, like the S&P 500 for example, we'll see that the average historically has been 8 to 10% every year. Now we've considered what the required rate of return would be, let's look at some of the historical performance of different asset classes. For example, as we can see, the US dollar over time has decreased in value, and that is because cash money has been historically a very poor investment due to inflation over time. This means that the actual purchasing power of your dollar has decreased year over year for a long period of time. For example, let's look at the price of a can of Coke. We can see that 50 years ago the price was much lower than it is today, and that's because the purchasing power of our dollar has decreased over time. Now let's look at some other asset classes such as commodities. Now as we keep looking at the chart, we can see that various commodities have different returns over time. For example, both oil and gold have had periods where they've been very successful and very poor investments, and this is dependent on the supply and demand of these commodities. However, when we look at both equities and debt, we see that over a long period of time, the two asset classes have had the historically best and most stable returns.
So, to conclude this video, let's think about what the time value of money is. Money today is worth more than it is in the future, and that's because of two main reasons. The first reason is inflation, and the second reason is that you can use the money to generate returns over time through investments, and that in itself holds an opportunity cost. So on the screen right now, you can see the formula. This formula shows compound interest, which is a common calculation used to calculate how much return you get with your investments. Thank you so much for watching this video, and in our next video we'll be talking about how we calculate the cost of debt. So make sure you subscribe and like this video, and make sure to not miss out on the future uploads in this series.